Welcome. Good day, everyone. In today's video, we will be discussing the exercise on the advanced accounting book. We will be looking at each questions and we'll be kind of diving into each questions, and I'll also be sharing my take on each of these questions. So let's just get started. We begin with the first question about direct and indirect costs of issuing common shares. This is the questions. So basically, a company called Pratama issued 1 million of its common shares with a par value of $20. They do this to acquire another company. And so during that, the Pratama company also incurred costs, to be exact, 200,000 for registering and issuing the securities, 50,000 for printing the shares, 100,000 in accountants for the business combination, 20,000 for delivering the securities, and 30,000 for transferring the assets of PT Sumber. This is the company that they are investing. And so the requirement of this question is to calculate the additional paid-in capital. Okay, so to put it simply, what I would do first to solve this question is to find out what additional paid-in capital means, right? These are kind of the informations. I've summarized them, and also this one on the bottom. But then, as I said, we need to first find what additional paid-in capital means. So what I did is I search on Google. What it means is the money that an investor pays above and beyond the par value price of a stock. I don't know what it exactly means, but the way I understand this is that it basically means that if you're investing, an investor pays something, and they invest. Additional paid-in capital is like the additional amount that you get aside from the common stock. Like that's how I like to understand it. And so the way I the way I put it here to solve the question is, let's just look at the journal entries here. So I have investment to PT Sumber. This is the investment that Pratama has made to PT Sumber is 40 million. I got this from here, and I got this from multiplying the fair value stock with the amount of shares. This should have not been dollar, but it's a mistake. But you multiply them, and it will result in this. And the same goes for the common stock. So it's the same thing, but I multiply by the par value, and so I put those two in, like this. And so just from an accounting perspective, we can already see that it's not balanced. We have 40 million against 20 million, so there's like 20 million more missing. And so how do you want to put that? You know what I mean? And so I think that's where additional paid-in capital comes in. That's where the account comes in. So this is exactly what I did. I put additional paid-in capital here. And the way I like to think of it is the amount that they are willing to pay, like, more than the common stock. Because in this case, Pratama is like investing 40 million, and they have like 20 million common stocks. And so this is just like the residual. I might be wrong here, but as for now, that's how I like to think of it. And there's also this journal entry that I made, which debits the additional paid-in capital and credits the cash. Okay, so where did I get this number, 270? I got it from here, actually, direct expenses, and I got direct expenses from adding these expenses. These are expenses that the questions mentions. So the cost that they incur when they are investing. And so direct expenses are the type of costs that directly contributes to the issuing of shares, such as these, printing shares, delivering the securities, registering. These are considered as direct expenses. And so then I use direct expenses to actually reduce the paid-in capital. The way it works is like, if you have like paid-in capital, you reduce it because you're also like making an expenses when you're investing, such as issuing the shares. So if you're like paying a certain amount, you cannot just say that you have additional paid in capital of this, because you're also paying these extra amounts. That's the way I like to think of it. And so I put it like this: debit on additional paid in capital and credit on cash. And this will reduce the additional paid in capital into 19,730,000, right, dollars. So, and this will be the final amount. So that's for number one. Now moving on to the next question. It's about goodwill. So the question is asking us to calculate the goodwill. So Winter Incorporated paid 50,000 in cash. 50 million in cash to acquire another company, and the another company has a net asset as follows. And in here they presented both on January and July, but I'm gonna be using the July data because they purchased the assets on July 1. So it fits into the questions. And so just like how I solved the first questions, to solve these questions you want to also know what is goodwill, the term goodwill is. And so in a more I think goodwill is that it's something that you gain from the purchase. That's how I like to think of it. And this will all like make much more sense once we get into the questions. So let's just get into it. These are the datas. These are the assets, I think. Yeah. This is also the assets, I mean, right? And so what I did here is I just added up all the assets, but we're gonna be using this one because this one is on July 1. Let me just write it down. Well, this one is on January 1, so it's not relevant. This one is relevant. So what I did here is I added up the total assets, because these are all assets, and I reduced the total assets by the liability, because accounts payable and notes payable are liabilities, and that results in this amount, 59,000, or 59 million. I'm sorry. And so the goodwill is just the difference between the total consideration at fair value, or as how I would like to understand it, is the amount that we pay and the amount that we get. Because when we pay this amount, we get this amount. Because when we pay this amount, we're getting the assets from the company that we're acquiring, and which in this case is worth this amount. So we just find the differences, and this is the goodwill. So that kind of solves the second question. Okay, we're gonna move on to the third questions, and in this question we have already moved to the second chapter. So this questions, Sultan Corporation pays a certain amount, and they get like 20% interest in a company named Chula, and so on and so forth. And the requirement here is to calculate the income from investment if they use the fair value and if they use the equity method. Now, I have calculated as well. This is the calculations. I'm just going to begin explaining it. So first, these are the datas that provided in the case. And this is also the things that are provided in the case. And so what I did first is I calculate this net income in a year and net income half a year. This will be important when I'll be doing the equity method. So this one. But before that, we're going to be calculating using the fair value. And so to record the payment, it's the same for both fair value and equity method, because it's, we're doing the same thing, right? We're investing in Chula for 500,000. So it's as simple as recording investment in Chula in the debit account, and we credit cash because we're expending money. We're reducing the cash that we have to invest. After that, if we're using the fair value method, we want to calculate the paid income from the investment, and in here we want to use the fair value. So to calculate the income from investment, using the fair value, we want to calculate using the amount paid that is relevant. So if you look at the questions, the question here state that they purchased 20% of the company, of the Chula company, on July 1. So dividends paid before July 1 should not be relevant to this case. because it's not paid to the Sultan company. Instead, it's, I don't know, But in comparison to September 1 payments, since the Sultan have already acquired the company, they will be getting payments, right? And so we want to use this number and multiply by the shares that we own, because 25K here is the amount that Chula pays to their owners, their investors. And we, as the Sultan corporations, since we own 20%, so logically we'll be getting 20% of 25, so that's 5,000. Okay, and furthermore, to record the payments of dividends, we want to record debit on cash and credit on dividend income, because we're getting cash because they're paying us cash, and and we want to credit the dividend income because it's an income account, if that makes sense. Now for equity method, there's like a little bit more to do. So the first is the payment. It's the same goes for fair value. It's the same thing, but then there's a difference in when we want to calculate the income paid from the investment, when we want to use the equity method. And so when we want to use the equity method, what we want to do is we want to pay attention not to the first information on A, but to the information on B. So in B, they provided the net income in 2016 of 150,000, which was evenly spread throughout the year. And so what this means is that because we're purchasing 20% of the company on July 1, and which is like kind of like in the middle of the year, we can just assume that if it's evenly spread throughout the year, then if we just divide it by 2, we should be getting the net income from July 1, the date we purchased, until December, from half the year. That's why I calculate this in the first place, because I want to use this number then to calculate the income. And so to calculate this, simply multiply this by the shares owned. It's the same thing as how the previous, the fair value method, because we only own like 20% of the shares, right? So we want to multiply this by 20%. Wait, let me just change this. Right, so by 20%. Okay. And so to record this, you want to record cash and dividend income. Is the same goes for fair value. To record it's the same thing. And then in my case, I also record the paid dividends. So paid cash 5,000 and investment in Chula, we reduce it because this one is interesting, because when we are getting dividends, when we're using the equity method, we want to actually reduce the investment in Chula account, because I like to think of it as that if we're getting paid by them, it's the same as kind of like we're converting the investment to cash, if that makes sense. So that's how I like to think about it. That's why the account is reduced and converted into cash, because these two are assets account, if I'm not mistaken. So that's for number 3, I think. I'm already on number 3. Moving on, number 4, point 5, about excess of investment over book value. We're going to be talking about overvalued and undervalued things here. So these are the questions. It's pretty similar. They purchase ATA PLCs, so they're trying to purchase the company, but then in the company has these assets and liabilities account. Inventory that was overvalued, equipment that was undervalued, and notes payable that was undervalued as well. And so we need to calculate the goodwill. So from the previous questions, I think number 2, we discussed that goodwill is like the difference between this and this, right? Between the amount that we pay and the amount that we get. But the case is different if we're only purchasing a part of the companies, so not 100%, because in this case Henry PLC only purchased like 5,000 out of 20,000, which means if we just convert it into percentage, it should be around 25%, the ownership of Henry PLC. And so in this case, the calculation of goodwill will be different. Okay, but we're still gonna be doing the same thing as first. So this is the common stock again, and this is the shareholders' equity. Since we only own 25%, that means the book value should be 100 times 25. So times 25%. So it should be around 25 million. And so if we compare 29 with 25 here, calculation of excess, we'll have an excess value of 4 million. Now, if the case was that we purchased the whole company, so we have 100% ownership, this will already be the goodwill. But because we only purchased like a proportion of the company, there should be more calculations in it. And when I say this, I mean because the case also stated that there are assets and liabilities that are over or undervalued, such as these. And so we need to include these into here to calculate the excess, to compare the excess fair value with the total of under and overvalued. So let's begin. At first, what I basically did in here is to multiply all of these by 25%. Why? Because this is the this is what the company has. So what was the name again? This was the Atta company, the Atta company's assets and liabilities. And since we own 25% of it, that means that we own 25% of each of these accounts. So I multiplied this 4 million by 25%, and I get this. Same goes for this. Same goes for this. Now you notice that there are values that are in negative numbers, and some, and like a couple in positive. Only one in positive numbers actually is the undervalued equipment. So let's start. So inventories, in this case, the inventories are overvalued by 4 million. This means that we actually have we have less assets than what we think we have. Because of that, the account should be reduced, right? Because the book stated that we have an amount that is too much, it's overvalued. Now for the equipment, since it's undervalued, means that we should have like more equipment compared to what's stated in the book. Because of that, the number is positive. And so notes payable, why is notes payable in a negative number if it's undervalued? Because the simple reason for this is because notes payable is not an assets account, it's a liability. So notes payable is something that we have to pay, right? And so if it's undervalued, it means that we should have been paying more. We should have more payables compared to what the book says. That's why this reduces the amount. And so if we sum this up, we will get 3 million. And to attain the goodwill, we want to simply compare this to this. Subtract these two, and we'll get 1 million of goodwill. So that's how you calculate goodwill if you only have proportion of the ownership, in comparison with the second question when we have like full ownership. Okay, now going to the last number. There's quite a lot in here. We have like 3 requirements, but first we need to make journals, we need to determine the balance, and we need to make an income statement. Okay, so to begin with the journal, first, if we're investing in a company, this is a must. We have to record the payments. So Pop company invests in Sun, so we want to record this. They're expending money to invest in Sun, so this should make sense. Now transferring the net income. What this means is that you want to transfer the net income from Sun company to the Pop company. But since Pop company only owns 30% of the Sun company, means that you cannot transfer all of these. You have to transfer like 30% of this. That's why I simply multiplied 600 by 30%, and you will get this amount. To record this, you want to add your investment in Sun account and reduce and add the investment income account, which is like a credit account. So that's for the transferring of net income. And then next we want to record the overvalued of inventory. So if you look at the questions, it says that the inventory is overvalued. Where is it? Here, it's overvalued by 200,000 because they're on a FIFO basis. what I want to point out there is the fact that the inventory amount is overvalued, and here I stated 200. And so we also want to assign this to the pop company. The reason here is because, again, when we're buying a company, we're owning the company, and since we own the company, we own basically like everything in the company, including their, I guess, overvalued inventory that was sold out. And so we want to assign this into the pop account using the pop's proportion of ownerships on the Sun company. Since we have 30%, that means the same as before, we want to multiply this by 30%, and we should get this. Sorry, I mean multiply this by 30%, and then we should get 60,000. Okay, now the dividends received, we also want to enter this as our journal. Dividends received is as I said, is the dividends that we received from Sun, because we invest in Sun, so we get dividends from Sun, worth of 30% of the total dividends paid. So to calculate this, we multiply 40,000 dividends paid by Sun with the 30%, since we own the 30% of it. And we want to debit the cash and credit the investment in Sun, because in here we're actually using the equity method. And as I said before, if we are using the equity method, we want to, the way it works, in my opinion, is kind of like if you're receiving dividends, is like you're converting your investment into the cash. So it moves from one asset account to the other asset account. And so in here, we're reducing this account and we're adding this account, the cash account. So that's like that. And the third and the last requirement here is to provide an income statement. They provided the sales and expenses, but in an income statement, since we already have all of these transactions and investments that we made before, we want to there's like a lot more things to include here. Okay, so we want to include sales and expenses, like before, and from here we can just find the operating income, right? And so because of our investment, we also want to do something with this operating income. This is not final, there is something more, and we get this from the investment income. So what is investment income, if you're asking, is the income that we get out of the investment. So if you notice here, there is an account called investment in Sun, and then this and this as well, and this as well. And what happens here is that the investment in Sun is being added and like deducted. And it's like that because there are these other things that we need to assign to the investment in investment in Sun's account, such as the net income, this net income, and then the dividends paid, right? And the inventory, the overvalued inventory. And so we want to add that here. This is what I did. So I add net income of this subtracted by 60. So, and then we got this as investment net income. Investment net income is not dividends received. So it's just the things that we like assign to the company when we invest in Sun. And so we add this to the operating income, and we should get this as our net income. And so this is like the final answer. Actually, one more. I forgot to solve number 2. So determine the correct balance. So first, we're just going to be looking at our journal entry here. We're entering 780, and then we're getting net income of 180 as calculated before. And then we have to deduct it because we have an overvalued inventory, meaning that we should have like less inventory than what's stated in the books. So we reduced it by this amount. And dividends received, we also subtracted because, you may say that if we receive dividends, that means we're getting something. But in this case, we're not getting investments, but we're getting cash. We're converting the investment account into cash in the last journal. That's why it's deducted. And so from there, the end balance should be 780. I think this concludes all of my answers. I hope it all makes sense. And yeah, I'll see you in the next video. Goodbye.